Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I have been following her work for a while. Excellent articles on Seeking Alpha, very well thoroughly researched, really good tweets to just put out some amazing charts and graphs, expanding on the work of Ray Dalio. Maybe we'll talk about that later in the interview. She is a global macro expert. She's appeared on interviews with George Gammon and others lately too. She's written, as I said before, a lot of very popular Seeking Alpha articles, a lot of global macro articles about the dollar, about problems in the US Treasury market. She also does stock analysis for Stockwave. So Lyn Alden, thank you for joining me.
Thanks for having me.
Now, Lyn, I want to get into the first question here. So the coronavirus is what's happened and the government response. The government response is probably worse, I think, in terms of economic damage. It's really thrown a monkey wrench into things. But in your opinion, how bad were things prior to the global pandemic, and how much has the global pandemic and what the governments and central banks have done in response to that changed or made things worse on your global macro views?
Yeah, so we were already having a slowdown in 2019 and also a little bit before then. So a lot of people look at economic indicators just in absolute terms, but the faster response way to look at it is in rate of change terms to see how it's changing in percentage basis over the course of a year. So for example, GDP has been positive for the US since the prior recession until now, but there's different growth rates along the way. So we had a slowdown in 2012, which was around the European sovereign debt crisis. We had another slowdown in 2016. And then in 2019, we were already getting a slowdown. So we're having kind of the third slowdown of this cycle. So GDP in rate of change terms peaked in about Q3 2018, and we're already seeing a downward move. And then of course we had the yield curve inversion, and we had a variety of recession indicators starting to flash, if not red, then at least yellow, and in some cases red. And that was all prior to the virus. So the virus came along, and whenever you have a situation that's this indebted and that's kind of already growing at a very slow rate at that part of the cycle, the virus is far more impactful on something like that.
And I think the virus, I would call it more the pin with the bubble,
Yes.
rather than the main problem, like you said, because I think it only highlighted a lot of the problems that were already in the system. It just exacerbated the problems. But I want to look back at history a little bit, because in 2019, I was warning people all year. I'm sure you looked at the data. I was looking at the export data out of South Korea, Germany. Germany was arguably in recession all of 2019. South Korea, the exports were getting worse and worse. And a lot of the indicators in the Chinese economy with auto sales and so many other things, those were getting worse and worse long before the coronavirus. And yet the US stock market was routinely rising a lot. So I was very, very worried about that. It reminded me a lot from a historical standpoint of 1927 to 1929, how the rest of the global economy was not doing well. There was a lot of examples. And then the capital, the stocks were still doing well here in the US.
Yeah, I think you can call that almost like the mini milkshake happening, the Brent Johnson theory about capital going into the US. So we had this period where the whole globe, including the United States, was slowing down in 2019, but it was more profound outside the United States. And in the US, even though the economy was heading down, we still had that meld up in risk assets. So we had bonds go to very low yields, and then we had stocks go very high. And reach pretty euphoric levels right there at the beginning of 2020.
What's your opinion on the repo crisis? Because the explanations that I think we got from Wall Street, from the US federal government, the Treasury, the Federal Reserve, I think they were BS. So do you think then that the repo crisis was based on how bad the global economy was slowing down all of 2019, that was a large part of it?
I think it was a big chunk of it, but not the whole thing. So back then, there were kind of two main camps. One camp was, the kind of the mainstream camp, which is, oh, it's not a big deal. It's temporary. It's seasonal tax payments. It's technical. All these, it's like not a structural thing. On the other hand, there were concerns about bank collapses or other kind of more imminent issues. My analysis indicated that it was primarily a Treasury oversupply problem. So by the end of 2014, when QE3 ended, banks in the US were filled up with cash. They had 15% cash levels as a percentage of assets. And then we entered a very strong period for the dollar from 2015 all the way to the present. And during that time, foreigners were not really buying treasuries, at least as a percentage of the total treasuries that were issued. So for several years, a lot of those treasuries were absorbed by domestic balance sheets, so like pensions, banks. But towards the end, all through 2019, we saw that they were accumulating on bank balance sheets. So primary dealers have to buy those treasuries at auctions and then resell them. But they were having trouble reselling them, it seems. And then right before the repo crisis, so foreigners started buying again in 2019, but between August and September, they sold off some of their treasuries. And that was also when banks were down to only 7% cash levels, and they were up to 21% treasury levels as a percentage of assets. So they were stuffed with treasuries, and foreigners suddenly stopped buying, and corporations were no longer accumulating T-bills. So we had this period where there's just dollar tightness and trillion-dollar deficits. So we had treasury oversupply, and that really kind of, I think, broke the repo market because banks were they were running into regulatory low cash levels. But then the foreign slowdown certainly plays a role because the strong dollar and the global slowdown meant that foreign countries weren't really accumulating treasuries. So that certainly played a role in the, kind of the timing for when that happened.
Yeah, I think we should expand on this a little bit because you talked about expanding treasuries. You and me have discussed this on Twitter. So when the global economy is functioning properly, we have other emerging market countries and emerging market companies. They're running trade surpluses, they're accumulating cash, and they park that cash. They're earning dollars from trade, from global trade, and they're earning that cash and then parking it into US Treasuries. Is that correct?
Yes, or at least a chunk of it, yeah, going into treasuries.
For the people out there who don't understand it, we're essentially on a dollar standard now. So after 1971, the last international gold standard, the last links to that were severed. What was it? Yeah, it was 71, right? Yeah,
Yeah.
71, and then Nixon legalized gold in 74. And so then we went on a full dollar standard.
Yeah, then from there, we've had these three big dollar spikes. So in the mid 1980s, and then again in the early 2000s, and then again in the late 2010s. So starting around 2015, we've had these three major dollar cycles of strength, like this big super cycle, and they happen every 15 or 16 years or so. And every time we get that dollar spike, something somewhere breaks. So we get in the mid 1980s, we had Latin American economies break from it. In the late 90s, we had a lot of Asian emerging markets break. And then in this period, we had pretty widespread breakage. We had Turkey, we had Argentina, countries like that broke first. But then also it just contributed to an overall global slowdown. And in all those periods, US corporate profits and US economic growth tends to slow during these strong dollar times because that eventually comes back to our shores as well, because many of our trading partners are impacted by it, and then that comes back to us.
And one more important point here, and you talk about this and I talk about this too, is there's a lot of demand for dollars and not for treasuries. So the average person is going to see that the dollar and the treasury, there's not that much difference, but there's a big distinction. Can you talk about why?
Yeah, so a lot of people just think it's the same thing because a treasury is just kind of a agreement to pay you dollars in the future. So they lump them together that if people have demand for dollars, they think they must have demand for treasuries. But in crisis scenarios, treasuries are a way to get dollars. If you sell treasuries, you can get dollars. So if you need to pay a debt, you can't really pay it in treasuries. You can pay it in dollars, unless of course you repo it or some other way of getting dollars. So if we look at during this recent sell-off, when the COVID crisis just started to hit the West, so we started to have this big S&P 500 fall. In the initial part of that, we had treasuries do very well. So yields went down, people bought treasuries, and then we actually had a big dollar decline down to about 95 on the dollar index. And so people went into treasuries, they went into yen, they went into euro. But then when we actually had the dollar shortage start to really become acute there, all of that reversed. So we had dollars spike up dramatically, and then we had foreigners sell treasuries to get dollars. And then we had so treasuries decline, like TLT, the long duration treasury ETF declined by about 20% in a very rapid period of time. And that's when the Federal Reserve started ramping up the fastest ever rate of QE. and they cited problems in the treasury market, and they started doing all of these currency swaps in QE to basically flood the system with dollars and try to alleviate that dollar shortage, because that's one of those periods, just like actually happened in 2016 as well, where dollars and treasuries become very separate things. So you have a dollar spike, and then you have foreigners selling treasuries to get dollars.
And we're recording this interview on Wednesday, May 27th. The dollar index is, I think it's above 99 the last time I looked. Let me just pull it up. It's at 98.93, dropped a little bit below 99. But do you think that this dollar shortage is only temporary? Because I think the longer this dollar shortage or the views of a dollar shortage go on, the more the people here in Congress, both political parties, want to spend. They want any excuse. They are all hot and bothered. They are planning meticulously all the different trillion-dollar ways, multi-trillion, to spend to try to weaken the dollar. So the Brent Johnson scenario of dollar index 120 or higher, in that scenario, Congress is just going to go absolutely crazy. They're going to spend trillions, $2,000 per person per month checks, maybe. We might get another check before that, maybe 1,200 or one for 1,200 or something like that. But in a scenario where the dollar index would rally, do you think then that Congress that would give them an excuse to try to weaken the dollar even more with spending?
I think both the Federal Reserve and the Treasury will try to deal with that. So if we go back to like 2018, 2019, early 2019, I was more bullish on the dollar. Not necessarily bullish, but I wasn't bearish. I was, for example, I release an annual report every year, and I ranked the dollar as slightly better than the euro for those 2 years. But then it was the repo crisis that shifted me into a somewhat more bearish dollar view, because now instead of having tight monetary policy compared to the rest of the world, we're shifting into more rapid balance sheet increases than most of the rest of the world. So now we're kind of entering a loose monetary policy in the US, but that's offset by the dollar shortage. And I think you described months ago the tug of war. You described that as a tug of war happening. So we have these kind of two very, very large forces, and I would describe them both as structural. So the dollar shortage is structural because it's an artifact of having the global reserve currency for this long, whereas the uh, the shift to loose monetary policy is primarily happening because we've gotten up to over 100% federal debt to GDP. We've saturated domestic and foreign buyers. So now the central bank is in a position of monetizing most of that new treasury issuance. So we have that structural kind of demand for dollars, that shortage. And then yes, I do think that going forward, dollars are going to be increasingly abundant because we're going to have very aggressive fiscal spending, and it's going to be monetized by the Fed rather than extracted from the system, which is what we saw in 2018, 2019.
Well, the other thing about the tug of war is if you look at President Trump's tweets, he's tweeted a lot about this in the last 18 to 24 months. The US Treasury policy, the Fed, Congress, they're all aware now of this dollar shortage. I'm sure they're getting briefings on this because we know that the Fed, there was even a Reuters article that came out in the last 6 weeks that the Fed is having long conference calls daily at one point with the other central banks. So they're well aware of the dollar shortage problem. They
Yeah.
don't like normally dealing with these global macro issues where they have to step in. But when they step in, you're right, you talked about, they know they have to step in and flood dollars and start devaluing the dollar because with the Asian tiger crisis and others, there were other dollar problems. The currency swap lines, the history of those, James Turk talked about that in his book, where they were initially small, but it was to bail out investment banks and hedge funds making bad bets, and the currency pegs blew up, and there was dollar shortages too. But really, the people here in the DC metro area and the Fed, they want the weaker dollar. So any excuse they have with a relatively strong dollar to spend more, they have literally a long list of projects where they could use the dollars to spend.
Yeah, and President Trump has been more transparent than many other politicians about, he's said before he wants a weaker dollar. Now he's flip-flop on that a little bit because he changes it depending on who he's speaking to, but he's been very aware of that, and he's been at least in sometimes more transparent about that than other politicians. Like most politicians wouldn't call for a weaker dollar because it doesn't sound good. And even in my view, I've talked about how the strong dollar is harmful, but that doesn't mean you want an artificially weak dollar. You want a dollar that's kind of at equilibrium rather than manipulated. So, but he does seem to be aware that the strong dollar is causing issues globally with that dollar shortage.
Yeah, I think before the coronavirus, Jim Rickards was talking about this, where the people in power wanted a managed decline of the dollar, so hardly anyone noticed it. But it's dangerous. You know, they were expecting to be able to manage the decline of it, and obviously now there's a monkey wrench thrown into it.
Yeah, if you look at, for example, we talked about the three big dollar peaks since 1971, but most people don't know they happened. They wouldn't know that. So most people wouldn't know that from 2002 down to say 2011. I mean, yeah, 2011, that we had that huge downward move in the Dixie in the dollar index. Most people didn't feel that. They didn't know that. It wasn't inflationary. From the politicians' point of view, yes, I think they would prefer to have another one of those events where you have dollar devalue kind of on a gradual pace in a non-inflationary way, or at least not a high inflationary way. That's kind of their, perfect world.
Do you think the system is so over leveraged that the dollar index or the trade weighted dollar index rising to Brent Johnson levels would collapse the whole system? I think the system would, because the amount of dollar denominated debt has more than doubled according to the Bank of International Settlements in the last 10 years. Then we have all those dollar liabilities with the forward dollar swaps. It's at least 11 or 12 trillion. It might be a lot more than that. The Bank of International Settlements, the estimates have been like 3 or 4 trillion, give or take different directions. So do you think then, because of the amount of dollar liabilities and leverage in the system, that the system collapses long before we get to any of those levels that Brent Johnson and Raoul Powell are predicting?
Well, we saw in March that when it got above about 102, it started to break then. So we had the Treasury market become illiquid. It sold off. The Federal Reserve cited that for many of their programs. So when they did the international repo, when they did the currency swaps, when they accelerated QE, both in their press releases and their meeting minutes, they cited the illiquid Treasury market. They called it that it ceased to function effectively. That was their wording. So about Dixie 102 was kind of the breaking point in this cycle. So if you go much above that, we're probably going to see the same thing happen again. We're going to see, we would see the treasury market sell off. We would see foreign central banks probably having to sell reserves. And it would get pretty messy again. You probably would have another sell-off in the US equity market. We tend to have these big bottoms in the US equity market when the dollar spikes. So that happened in 2009. That happened again in 2016, and then it happened again here in March of 2020. So yeah, I do think it would break when you start to get well above Dixie 100. And of course, it also depends how long it stays there. So it can spike for maybe weeks at a time, and you'd have this kind of emergency situation again. And then it would come down to how fast they respond and how effective their responses are.
Just excellent analysis on the dollar. I think our listeners are going to really appreciate you and me spending that extra time going back and forth talking about how we see what's going on with the dollar. I mean, I respect Brent Johnson and all their views. I just think in this system, I think what he's not accounting for is all the crazy spending projects that the president, the White House, Congress can come up with as soon as the dollar index starts to rise to anywhere near the levels that he's expecting. I mean, we have Democrats, we'll see what happens with the elections in November and in the next congressional elections. But if those do swing back, I mean, we're going to probably see even more MMT light type of checks coming to people in the not too distant future.
Yeah, I mean, I've enjoyed debating a little bit with Brent. I think he has a valid point of view. I see things a little bit differently, and just my kind of analysis of the dollar bull argument, just from multiple people, is that they're not taking into account that yes, there's a dollar shortage that depending on how you measure it is 12 trillion. There's easy ways to get up to over 20 trillion, but foreigners also own 40 trillion in U.S. assets, including 7 trillion in treasuries. And there's not a perfect overlap between the countries that have those liabilities and the countries that have the assets, but there is a significant amount of overlap. So as we saw in both 2016 and 2020, when the dollar spikes, we get a big sell-off in U.S. assets out of necessity to service their dollar-denominated debts. So that combined with the sheer amount of spending and debt monetization that is likely to come over the next several years, I think keeps the dollar in check most likely. Now, to Brent's point, that doesn't mean it necessarily works out kind of smoothly. So, for example, you could have disagreements in Congress about what to spend money on, And then, if there's a delay and if there's a faster kind of crisis happening, the government authorities won't necessarily move fast enough. So, one of the dollar bull cases is that they just simply won't move fast enough to kind of get ahead of the problem. But I view that ironically as betting that the government won't spend enough money, which, you know, I don't know if I would take that bet.
Well, it sounds like, based on all the stuff that you were saying and analyzing the different arguments with Brent Johnson and Raoul Pal, that if we do get this dollar super spike, it will not last for a very long time.
Yeah, it'd be so disruptive that it would either break and you'd have kind of emergency crisis actions, or that they would never let it get that high to begin with. And I'm not sure which one would be the case. I have, my base case is that they'll control it, but if it does get disorderly, once you get well above 100, that gets very disruptive for global markets, including U.S. markets.
Yeah, and that's when you see like the Plaza Accord or FDR 1934. They do have options that they could pull out. They're not ready to use those quite yet, but they do have those options.
Yes.
Okay, so let's transition now to your new article, first liquidity, then solvency. Does this have to do with the global cash flow problem now that's happening? Because my thesis has been that with the coronavirus, there was obviously a enormous problem with total debt throughout all levels of society. But now the cash flows that are projected for governments with their tax revenues, for large corporations because their balance sheets are leveraged, for small businesses, individuals, families and individuals, that now the cash flow problem is really making things worse.
Yeah, so in March, we had that big liquidity crisis where we had the dollar spike. We had both domestic and foreign sources sell off. We had risk parity funds cause problems. All of these things kind of happened at once. So we had that. It was a very liquidity-driven crisis. And then the Federal Reserve has, with all their programs, they've gotten ahead of that. So then the more structural issue going forward that could take, the rest of this year and then into the next couple of years is a solvency crisis. So we have just countless small businesses, restaurants, both companies that are directly impacted by the shutdowns, and then also just indirectly, like their suppliers, Uber drivers, this very large cash flow problem, as you put it. And I think people underestimate how lingering that's going to be compared to the consensus view, and then probably how large the kind of ongoing federal spending will be to try to address that, especially because they're not going to want angry voters before an election. And then even after the election, regardless of who wins, you have that feedback loop where the longer they let that go and linger with high unemployment, the more negative feedback they get in terms of votes, in terms of, social unrest. So, my view is that we're going to see kind of a rebound in some sectors, but it's going to take probably a lot of crisis level spending that we're going to see over the course of years, and that is not very dollar bullish.
Yeah, printing 12, well, they're actually printing the checks, or some people are getting them wired, $1,200 per person checks, or the SBA loans, or unemployment, where some people are making, I've seen estimates now, 2/3 of the people on unemployment now are making $600 or more extra per week, or at least 450 now. Congress, since they've screwed that up, now they're debating how to deal with it after they already screwed that up. So that doesn't solve the cash flow problem, because small businesses need cash flow, governments need tax revenues. I mean, I've called cash flow the gasoline that powers the economic engine. Everyone needs cash flow, especially if you have a leveraged balance sheet. Everyone has, if you're a large corporation, you have an acceptable range of cash flows where you could service your debts. And it's very similar with tax revenues too, with governments. So when the cash flow stopped, now is when you're getting all those problems. That's when you're seeing the emerging market governments, like you said, want to liquidate their treasuries because of the cash flow problem.
Yeah, I think small businesses in the US are the key place to watch, because these large companies have gotten by pretty well, at least outside of certain sectors. Whereas small businesses, we have more of a lag in the data, and we have to see how they do over the next year or so, because if they go away, that creates more structural unemployment rather than employment that can snap back pretty quickly.
Yeah, I think there's going to be stagflation. Now, a lot of people are like deflation this, deflation that, but the more intervention by governments and central banks, the more checks they give people on unemployment, there's not as many goods and services being produced, and there's more currency and bailout money that's going around with less goods and services. So I think there's a lot of higher costs, whether that's politicians forcing higher wages or problems in the global supply chain. I think there's a lot of higher costs all over the globe that are going to be put into the global supply chain. I think that misallocation of capital and malinvestment is going to cause stagflation.
Yeah, I think we're having a very brief deflationary shock at the moment, but then, as we move forward into this year, and then especially in the next several years, my base case also is that more stagflationary outcome.
Which it would not be good for the average person listening to this podcast unless they're entrepreneurial and they're going to figure out how to grow their income.
Yeah, it's going to be rough, I think, and it's going to be a period of a lot of transition. So people that have savings, diversified assets, people that have multiple income streams or income streams that are resilient and that they control, they can do pretty well. But people that are very reliant on an employer income stream, or people that don't have a lot of assets, they could, or a lot of debt, they can definitely face a lot of issues. It's going to be very hard, I think.
So let's talk about how governments are going to deal with all this. I've talked about before the coronavirus, my base case was that governments were going to try to do stagflate and tax and lie to devalue their currencies, to devalue the debt in real terms. And the average person, even though they weren't going to see it in the inflation statistics, their standard of living was going to be eroded away through inflation, currency devaluation and taxes, and the governments were going to lie about this. So you have talked in past Seeking Alpha articles and your interview with George Gammon, which is superb. I highly recommend listening to it, about how the US wants to use a similar strategy to what it did in World War II, and also what Japan has done for decades now. I call it Japanification, to deal with its debt. Is this still possible with the amount of spending that the Fed and Congress have planned for the global pandemic, or have things changed now in your opinion?
It actually even mirrors even more closely the last time they did it. So the last time that the Federal Reserve did yield curve control was in the 1940s in order to fund World War II. So back then they had deficits that were as big or bigger than we have currently. And debt, federal debt as a percentage of GDP got over 100%. That's the only other time in American history where it got this high. And the way that they, quote unquote, resolved it is the Federal Reserve closely worked with the Treasury. They capped Treasury yields at 2.5% or below. So it was less than 1% for the short end of the curve, and it was 2.5% for the long end of the curve. And it was basically QE. They didn't call it QE back then, but they created dollars, they bought treasuries as needed to maintain those pegs. And so even though there were periods of high inflation during the 1940s, so we had these spikes of double-digit inflation, but they still locked the treasury yield curve at 2.5% or below. And so treasuries over the course of that decade lost money compared to official CPI. And compared to real estate, compared to equities, treasuries lost out on a real basis. And they've already talked openly about doing that again. So back in 2019, before the virus, they were talking about doing yield curve control. And then in response to this large treasury issuance, I basically argued that they're already kind of doing soft yield curve control because the Federal Reserve has bought all net new treasury issuance since the repo crisis. So we've issued trillions of dollars in treasuries. They bought trillions of dollars of treasuries through the primary dealers. And when we had that big sell-off in the treasury market in March, the Federal Reserve fixed that by buying up to 75 billion a day in treasuries. And they were pretty transparent about that. They cited that they fixed that it was illiquid, so they bought at a very high rate. And in their latest meeting minutes, they talked again about probably doing yield curve control across the full duration treasury spectrum.
Yeah, also to add to your points there about World War II, what the Fed did with yield curve control. I mean, during a war, there was wage and price controls, there was rationing, and pretty much every war throughout history, no investor makes money on the war except for the bullets and bomb manufacturing companies. Any of the people who buy the war bonds, normally it's a subsidy to the government. So it's used with marketing to sell the war bonds, but it's not a profitable investment historically.
Yeah, treasuries did very, very poorly during that whole decade. That I have a chart out there that shows that over a 10-year period, they lost money on a real basis, even though they went up in nominal dollar terms. And then, there were periods during that where, like if you bought at the low in 1942 in stocks, you did well, but it was a very rough period for investors in all asset classes through that period.
Yeah, I think Sir John Templeton did really well, but he's one of the very few investors that actually did well during that period.
Yeah, he bought low. Another thing that was going for investors then was that, understandably, after the Great Depression period and then during the war, stock valuations were very low. So things were bad, but there was so much blood in the streets, as the saying goes, that equity valuations were very low. So when you combine that with that more inflationary environment, turned out to be pretty good purchases if you bought them at the lows. Same thing for real estate. That was also a pretty low price back then. Whereas now equity valuations are very high. So it's kind of a different environment in that sense.
I want to get your opinion on what Japan did for the last couple of decades. So, for our listeners not familiar, they were the only country doing it. I feel like they allowed the yen carry trade, they allowed these investment banks, these hedge funds to go and borrow yen cheaply and then go and put it into other currencies. Do you think that that monetary inflation that was in Japan, they exported a lot of monetary inflation? Do you think it caused asset bubbles all over the globe for decades?
I think it could have contributed. I view Japan as kind of a unique case because they have such strong deflationary forces in their own economy. So they have a population that is shrinking and very aged, and then they had rapid technology expansion, and then they have that very strong kind of social cohesion, and they have a very strong saving tendency. And so when I analyze that country, uh, they did rapid QE. People often talk about that they've been doing QE for decades, but it was really in 2012 that they ramped up QE to a massive level. They brought their balance sheet from about 30% of their GDP all the way up to over 100% of GDP from late 2012 to now. So during that period. And at first, it devalued their currency a little bit, not in like an outright inflationary way, like they didn't really experience inflation there, quite the opposite. But the yen devalued versus the dollar versus the euro. But then after their trade balance normalized, because they have a positive trade balance, they have a positive current account balance, their currency was able to stop weakening, even though they've kind of thrown the kitchen sink at their currency in terms of low rates and QE.
Well, one of the reasons why the currency doesn't weaken as much as they like is because they own a lot of treasuries. So they have a lot of exposure to the dollar. So that's something that people I've spoken to about Japan in the past have brought up.
Yeah, they have over $1 trillion in US Treasuries. They've kind of gone back and forth between China as the largest holder of US Treasuries.
Yeah. So if they wanted to weaken their currency more, they would just start selling the treasuries. But I don't think they'll do that though.
Yeah, I think from their point of view, their currency is at a pretty good equilibrium because when they started QE in 2012, they had a trade deficit, which was actually pretty rare for Japan. And when they started massive QE, massive money printing, when the yen did devalue pretty sharply for those 3 years after that, from 2012 to 2015, they had a pretty sharp yen devaluation, but then it made their exports more competitive. It made their imports more expensive, and their trade normalized pretty quickly by about 2015. And then from there, even though they never slowed down QE, they didn't really change much. Their currency stopped weakening, and then compared to the dollar, it mildly strengthened from that low point uh, because trade was normalized. So there are a lot of factors that can go into it.
Also, I have friends who have lived in Japan for 10 years or more, and what they've told me, they always complain about taxes. So, the Japanese government, and this is not included in the inflationary statistics, and I think people have to combine inflation with taxes. So, even though people are saying that there's lots and lots of deflation in Japan, there's been lots of tax increases. So, either there's new taxes created, or things like the value added tax or other taxes are just layered on. So, it's a very high cost of living in the major Japanese cities to rent an apartment, to buy food, and there's tons of taxes. So that's something that
Yeah,
the government statistics are not accounting for.
yeah.
Next question then about Japanification. So can the US, European Union, China has even talked about this. Some of my sources in China have said that the Chinese government thinks, their economic central planners, the people in their government, and the People's Bank of China think worst case scenario for China is Japan. So can all these major governments or economic zones, can they all successfully copy Japan, what Japan has done for years going forward?
Perhaps at different degrees. It's often said that history doesn't repeat, but it does rhyme. So if we look back to prior periods of currency devaluation, there were periods where multiple currencies could devalue at the same time. So for example, if you look at, during the Great Depression, all the major currencies devalued versus gold. So the dollar, the yen, the pound, the franc, they all devalued versus gold, not all at the same rate and at the same time, but all within a couple years of each other. And that was a part of the reflation attempt to, kill deflation and get inflation back. But of course, what's different this time is that there's no gold standard at all. All these currencies are fiat currencies. So there's always that new variable to see in this environment where the world is basically on a dollar standard. How's that going to happen if all these currencies are devaluing and even the dollar is devaluing all at the same time, and that there's no hard reference for any of them? So that's going to be kind of a new thing to watch.
Also, all these central banks increasing their balance sheets, and you're covering this extensively. What there's been 20 trillion in total liquidity if you add up all the different central bank balance sheets increases, and then the fiscal stimulus spending by the governments in just the last couple months. I mean, that's monetary inflation. It's going to cause price increases somewhere. I think there's a strong argument that it's one of the main reasons for the US stock market rallying, and it's caused other asset prices. So for now, it appears that a lot of this monetary inflation and credit is just causing asset prices to rise mostly.
Yeah, so over the past decade, we've had in the US, we've had about 5% per capita money supply expansion, M2, per year. So we can call that a 5% per capita inflation rate. And then the official CPI is lower than that. And I think, as you pointed out, a lot of that inflation basically wound up in asset prices. So it wound up in stocks, it wound up in real estate. If you look over the full, all the way back to the beginning of the millennium, even gold, a lot of the money kind of found its way in gold because we had that large increase in gold prices. We've had that. We've had healthcare costs go up pretty rapidly. In general, if you separate goods prices from services prices, services have more closely tracked the growth of the money supply. So we've had healthcare prices that have gone up roughly in line with per capita money supply. We've had education prices go up pretty rapidly. And then we had some consumer, consumables go up pretty fast. So food prices, uh, things like paper towels, and you've called it like shrinkflation. So we've had kind of subtle ways to have inflation, whereas the main areas where we've seen deflation or disinflation are things that we can export, like goods, technology items, electronics, TVs, car parts, things like that.
Do you think then prices for consumer discretionary items are going to fall? Because if people aren't getting the cash flows they need, if people don't have discretionary income, people don't have savings to consume, and they already have a lot of credit card debt that might default, they're not going to probably be able to buy as many discretionary items, and unless the economy starts getting back to normal economic activity to pre-coronavirus levels.
In the near term, yes, because for example, people aren't buying cars, people aren't going out and buying appliances in this environment, and if they're cash strapped, yeah, they're going to focus on the necessities. So that's part of why, I'm expecting stagflation in the kind of intermediate term or longer term, whereas the first half of this year, because there's such a large deflationary shock, such a disruption to incomes, we are seeing that big drop off in these, especially large discretionary purchases, where people don't want to make a big capital investment or a big, personal investment, a big acquisition like that.
So, as part of this yield control Japanification strategy that these major governments and economic zones are going to try, are they going to attempt? So, the European Union has already done negative interest rate policy. My friend Daniel Lacaille is a professional money manager in Europe. He's written extensive articles about this. It's caused immense amounts of damage throughout all levels of the banks, the insurance companies, the pension funds, the savers. So the European Union, there's tons of examples that negative interest rate policy with Japanification does not work. Do you think these other governments, like the US and others, are still going to try it anyways?
They're saying they're not going to. I don't know ultimately what they're going to do. I hope they don't. Back in the 1940s, they didn't have to resort to negative interest rates. They had a positive yield curve that they controlled, and they let inflation run hot over that yield curve. So in this environment, because population growth is slower and demographics are more aged, they have a harder time coming up with nominal, like actual price inflation on discretionary goods. So they might try to go negative. Like you said, it has not worked in Japan. It has not worked in Europe. So I think they're starting to see that. I mean, as we've had years of seeing it not work, um, the Federal Reserve has said that they don't plan on using that tool. So we'll see. My base case is that they won't, but you have to monitor that over time.
Yeah, because I'm trying to think what could actually go wrong if they attempt to do this. I mean, we already have wealth disparity now. Can it actually get a lot worse? Are they going to start sending out well over $1,000 per person checks here to the US? Because I'm just thinking about how people are getting really pissed. Capitalism is getting blamed for stuff that governments and central banks are doing, even though it's not capitalism. So the more that governments and central banks try this, I think it's going to destabilize society. The more negative interest rate policy or Japanification that's tried.
Yeah, I think most likely they're going to try money printing over negative interest rates. So when they hit the zero bound, there's a couple options. One is that they can dive into negative rates, and the other option is that they can use these QE and other money printing activities. So that's what we saw in the past crisis, and then in Europe and Japan and the US, they've all been kind of continuing that to various degrees. So in this crisis, a lot of that spending is getting more to the people. So instead of recapitalizing the banking system with QE, they're using QE for helicopter money, sending money out either as checks or unemployment benefits. Uh, they could do it for infrastructure spending, but that requires a little bit more bipartisan support. Um, so most likely, in place of low interest rates, the U.S. is probably going to do very aggressive fiscal policy that is combined with debt monetization to pay for those deficits. I think that's what they're going to do, but it's always possible that they're trying to combine that with negative interest rates. But currently, they're saying they're not going to, and I think they see the evidence that it hasn't been successful anywhere else.
Yeah, it could really hurt the bank. The academic Keynesians think that negative interest rate policy, I think from a theoretical standpoint, they're thinking that it will force people to spend because Keynesians believe in the paradox of thrift. So they're thinking that people won't hoard cash, people won't save. They force negative interest rate policy that will force people to spend in the economy, that will get consumer spending going, because that's what a lot of the economy is based on. But I think it will destabilize things even more with the banks and the insurance companies. And the banks, a lot of people aren't talking about this yet because the loans are, I guess, on forbearance terms. They're not being technically defaulted yet. But these large banks right now here in the US are sitting on enormous commercial real estate loan books that in a couple months from now, if the cash flow doesn't come back, there's going to be some really big defaults.
Yeah, if you look back, when we had that period of high inflation in the 1970s and 1980s, uh, we didn't have a lot of debt increase during that time because it was very risky and challenging to take out loans because interest rates were so high. As interest rates came down, we had an increase in lending and an increase in borrowing. But I think people mistake that to assume that just because, going down from very high interest rates to moderate interest rates encourages borrowing and lending, they seem to think that that relationship remains linear, so that the lower you go in interest rates, the more and more and more people will borrow and people will lend. But that's not really the case. We've seen that once you get to extremely low levels, lower interest rates don't encourage people to borrow more. Like you're not going to borrow more at 1% than you would at 2%, just because at that point, absolute debt levels matter, income matters. There's only so much they can borrow, and banks end up lending less. Like in this past cycle, they've mostly just been hoarding cash and buying treasuries rather than making actual loans because there's too much risk out there, and they're not being compensated with high interest rates for it.
Or the banks are acting like hedge funds and they're playing in the derivatives market or collateralized loan obligations, or they're leveraging up their bond portfolio with the hedge funds that they're funding. So the banks, like you said, are just not doing those Main Street loans. Anyway, with the cash flow problem that we have, a lot of these small businesses are not going to be, the lender is going to look and say they're not good credit risk because they don't have the cash flow yet.
Yep. Yeah. Every one of these recessions, we get a tightening of the cycle. So we've already had JP Morgan and other large banks uh, tighten standards for both consumers and business loans.
One more point I wanted to talk to you about with stagflation and the topics that we discussed is that some people are saying you can't have that you can't have inflation with low velocity money collapsing. And my argument is that you can have a lot of stagflation with velocity of money low, because it's just going to screw up the supply chain. It's going to force costs higher. You could have politicians then trying to move wages up. So all these costs and misallocations of capital could cause a lot of unintended consequences to the global supply chain and costs for people who are actually producing goods. Plus, with the coronavirus, there's less goods and services being manufactured, although that might only be temporary.
Yeah, I think also one of the variables for declining velocity in the past couple decades was we had this period of wealth concentration. So a lot of the QE, it never really went to the public. It just went to recapitalizing banks, and then it went into asset prices where people in the top few percent got most of those gains. If we transition into a period where there's a lot of fiscal spending on helicopter money, unemployment benefits, infrastructure, things like that, and all of that is financed by debt monetization, by QE to fund those, kind of direct to consumer spending. That's a mechanism to get money more to people, but then that can turn into higher velocity, and with that, or at least even just stable velocity. If velocity just stops decreasing while the money supply keeps increasing rapidly, then you can get a resumption in inflation.
Well, I still think we can have a lot of stagflation even if velocity doesn't go up that much. I think it's going to make a mess of the cost structure for
Yeah,
producing goods. And until we get goods back to normal levels, we're going to have a lot of what Keynesians would call this cost push inflation. So I think we're going to get a lot of cost push inflation until normal production levels resume.
it's certainly possible. Yeah, and we've already seen that in at least some niche categories. So it's that can always happen more broadly.
So I want to transition now to emerging markets. We disagree on this because I think a lot of emerging markets, their business model, a lot of them, unfortunately, was they saw commodities bull market, they saw the China growth story, and since 2008, China was, I would say, fairly the main economic growth engine for the global economy. But them growing at those levels with that economic central planning and building out, it wasn't sustainable for them to build at those levels. Emerging markets are starting to default on the debt they owe to the Chinese, which is somewhat surprising, and many have a dollar shortage as well, with dollar-denominated debts too. Why are you bullish on emerging markets when it looks like there's a lot more pain coming in the form of defaults at the government level and bankruptcies at the corporate level?
Yeah, so what I do is instead of looking at them as a group, I treat each market as its own entity. So like I publish a report every year where I look at over 30 countries, and over half of them are emerging markets. And so every country gets kind of looked at individually to see how much debt does this country have, how much reserves as a percentage of GDP does this country have, what types of exports do they do? Do they have a trade balance that's positive or negative? How commodity dependent are they? Are they an exporter of commodities, or are they primarily an importer of commodities? So for example, both Russia and India are emerging markets, but in many ways they couldn't be more different. So Russia's slow growth, India's fast growth. Russia is a commodity exporter, India is primarily a commodity importer. Uh, India has more higher valuation for things. Russia is very cheap because it's slow growth and troubled. And then you have countries like Turkey that have very high dollar-denominated debts in their corporate sector, whereas a country like Taiwan, which is classified as an emerging market still, they have low dollar-denominated debts and they have very high treasury reserves, very high foreign exchange reserves overall. In total, every emerging market's separate and they all have their own different risks. So my point of view is that many of them are very inexpensive, and that if we do start to get a weaker dollar period and higher global liquidity, then you could see a rebound, especially in many of the, many emerging markets are commodity producers, but you also have ones like India that are not reliant on commodity exports. And in fact, India benefits from a lower oil price. After this crisis, starts to abate, at least the actual virus part, and economies start opening more readily, I do think that at these lower price levels, if we start to see a lot of dollars being printed, that some of these emerging markets could do very well in that environment. They're at lower valuations. Many of them have lower absolute debts as a percentage of GDP. Not all of them, obviously, like China has very high debts. But if you look at them individually, many of them are very low in debt. And so if you find ones that have low dollar denominated debt and low overall debt and higher reserves, and if you focus on do they have trade balances, how commodity dependent are they, I think there are a lot of gems out there.
Yeah, there is some hidden geopolitical risks. Like you mentioned good things about Taiwan. What worries me about Taiwan is the Chinese government and how attacking Taiwan in the not too distant future and taking it over could be a very big risk. So, from an economic standpoint, Taiwan sounds good, but geopolitical risk, it sounds very dangerous with the rhetoric that's coming from the Chinese government in just the last couple weeks.
Yeah, one of my approaches is to not invest too heavily in any one country because there's always tail risk. So Taiwan has that very clear tail risk. So their more normal risks are that they have, pretty slow growth at this point. They're even though they're classified as emerging, but they're actually pretty developed. So they have a low population growth rate, but they have very high technology. That's actually another incentive for China. Hopefully they don't do it, but another incentive for China to try to get Taiwan to join them is because Taiwan has that semiconductor manufacturing capability that China wants. So there are tail risks like that. So rather than say make a big bet on Taiwan, I'm bullish on countries like Taiwan, Vietnam, South Korea, uh, just different countries spread across the globe, each in small amounts, and they all have, their own risks. But as a collective, uh, historically, a globally diversified portfolio, even though each country has a tail risk, it's generally less exposed than if you put all of your assets in your home country, because your home country can have valuation risk, and it can have major political tail risk that can happen. And if all of your assets are there, uh, you can have a very large event where you lose a lot of purchasing power.
Yeah, I think managing and limiting risk is very important. The average retail investor just doesn't understand this. So they see emerging markets as a wide class and they buy an ETF. And unfortunately, Lynn, in many cases, a lot of people who buy ETFs like this don't even look at all the stuff that's in the ETF. So they say they have emerging market exposure, and then they don't look at exactly what's in the ETF. And in a lot of cases now, with a lot of these emerging market ETFs, there's too much exposure to a single country. Normally now it's China, because the largest emerging market ETFs all have disproportionate amounts of Chinese exposure.
Exactly. That's one of the things I pointed out specifically is that emerging markets ETFs are very heavily weighted towards China because they're market cap weighted. So that's one reason I promoted owning some single country ETFs if they want to diversify elsewhere, so that they can buy emerging markets without necessarily buying heavily into China.
Do you think if China loses a lot of factories to India, that that would really heavily benefit the Indian economy? And do you think that's pretty likely in the next 10 years?
I think it could. It's also a gradual process. So it takes a long time to build that type of infrastructure and those types of supply chains. I am bullish long term on India. I think they can get manufacturing capability. They already have, they already are strong in software. They're pretty strong in healthcare production. They do have some manufacturing capability, so I do think they could grow that over time. And that's also one of the bull cases for commodities is that India does have, if you look at, say, copper usage of India, they have a lot of potential to grow their copper base because they have very low per capita consumption of copper. So if they move up to even, say, half of the per capita consumption that China has, that's a source of copper demand. So I do think India represents something to watch because they have a lot of risks related to, because they're so population dense, they're very exposed to climate risks. So especially access to water and especially how it affects their agriculture. So they do have a lot of risks. It's also just a very challenging country to manage because it's so populated and it's so like not uniform. Like so many different subcultures within the country. So it's definitely a risky area, but I think it's a very promising one to watch in terms of demographics. They have pretty low debts. They're not one of the places that has very high dollar denominated debts. So I do think that's a pretty good place.
One of the major risks for emerging markets that I've heard people like Brent Johnson and others talk about is these dollar pegs. So dollar pegs tend to last a while, but they cause an enormous amount of damage when they break. So do you think that this is one of the major risks for a lot of these emerging markets, is the ones that have dollar pegs, those breaking, and then the damage that's caused, like in the Asian tiger crisis?
Yeah, I wouldn't trust pegs, especially ones where they don't have a lot of reserves. So Lebanon, of course, has been a case where their currency peg has not worked out very well. Uh, and then we'll see how that works for some of the Middle Eastern countries. We'll see how that works for Hong Kong over time. Hong Kong does have a lot of reserves, but they have a lot of geopolitical issues that could put a lot of pressure on that.
Oh yeah, we're seeing that now. I mean, if the Chinese
Yeah,
government fully takes that over, those reserves could be confiscated.
yeah, it's possible.
And the Kyle Bass has done extensive work on this, on how leveraged the Chinese banking system is.
Yeah,
Excuse me. Well, not the Chinese. Well, he also talks about that. I mean, the Hong Kong banking system.
yes, yeah, because their leverage extends outside of Hong Kong because they do a lot of activities in the whole surrounding region.
Oh yeah, it's very very leveraged to Hong Kong real estate and real estate in mainland China.
Yeah, I actually, Hong Kong was a place that I stopped covering in my reports because I covered them in earlier reports, but due to recent geopolitical events, I now classify them fully as part of China. So I don't isolate them, and I no longer consider that kind of a separately investable market because now it's really more part of China.
Yeah, and I don't trust Chinese companies with the accounting fraud, so I just stay away from those.
Yeah, makes sense.
So I want to ask you now about gold. I know you've made a lot of comments on Twitter and your articles about being bullish long-term gold. Is there a global macro scenario where you do not see gold and gold stocks doing well?
I think certainly for brief periods. So for example, we saw in March how gold stocks sold off even more aggressively than the S&P 500. And we saw gold and silver, at least their paper prices fall. So physical gold and silver, even in that very kind of deflationary shock, liquidity shock environment, even though the headline prices decreased, the actual price to get your hands on the metal either stayed the same or for the most part went up. It was almost impossible to actually get your hands on the metal for any sort of reasonable premium. So unless there's a very long deflationary collapse, I, it's hard to see a long-term period of declines for gold and silver. But even if that were to happen, uh, although gold and silver might not go up in dollar terms, you would see such destruction in the equity market and in other markets that the purchasing power of gold and silver would probably hold up. But there's certainly, I think the biggest risk is time frames. So those sorts of long macro things can sometimes take longer to play out than you think. So for example, despite all of what we've seen now, gold still has trouble holding the $1,700 mark, which a lot of people would not have expected. They would have thought it'd be at new all-time highs by now. So these metals can take a lot of patience because they don't always move as fast as people think. So I think that's the biggest risk, is that the long-term direction's up, but there can be many months or even multi-year periods where they don't go up nearly as fast as you think they should, or they even go down.
Well, gold was at or near an all-time high in pretty much every other currency but the gold price in dollars.
Yes.
Now you mentioned gold not doing well in deflation. The really the only historical case example that I've seen for a long period of time was after the October 1929 crash, where we had deflation for a while until the dollar was devalued against gold. And homestake mining and dome mining, so the price of gold was not rising, but their costs were falling faster than the price of gold. So homestake mining and and dome mining, their shares went up hundreds of percent, and they increased dividends every year. So that's really the only historical example I've seen in the modern era of a deflationary scenario where the gold stocks, where we have any period of time for a couple years or so looking at how good or bad the gold stocks have done.
Yeah, I think the sell-off that happened in March for them was very irrational. So I was kind of pounding the table to buy them at those low levels because, as you pointed out, their cost structure, even though gold went down a certain number of percent, their energy costs went down way faster. So their profit margins were actually kept intact pretty well. So um, I don't have too many cases where I see an outright negative view for gold, silver, or gold miners, as a whole. For me, it's mainly about the time frame risk. So uh, in that deflationary environment of the 1930s, uh, that dollar peg that was reduced, that was the kind of the anti-deflationary move from the government. So we had from 1930 to 1933, we had crippling deflation. And then when they reduced the dollar peg, they printed a ton of money, they did tons of programs, and we started to get that more stagflationary environment or reflation. And that's when gold, by definition, went up in price in dollar terms. But then, as you point out, the actual mining companies still did well during that period. So in this particular period, because there was such a liquidity shock, because markets are more financialized now than they were back then. We still had funds selling off their gold, selling off their gold miners, even though their underlying fundamentals were fine. So I view those types of events as buying opportunities if they happen again.
The crash in gold stocks with the margin call liquidation event with a lot of different stocks, but gold stocks, a lot of people were angry that gold stocks crashed for a couple weeks. We had Franco-Nevada, I think, dropping down to $85 a share. Sandstorm Gold was briefly below $4 a share. I think the mistake that most people make when they buy gold stocks is they see the fundamentals of a company, or they like the story a lot, and then they buy way too much of their position all at once, and they don't have any cash in case there's one of these events like what you're saying. People have to have cash for opportunities to take advantage. So in case there's another stock market crash, people need cash to go and buy the good shares of good companies that they like on sale.
Yeah, that's why I hold a portion of my portfolio in cash and T-bills, because even though I expect currency devaluation over the long term, it's still useful for these liquidity shocks that we have to be able to buy at those lower prices. So, if I had my whole defensive position in precious metals, I would not have been able to buy more miners like I did in March. Definitely, I found that having that cash buffer combined with the precious metals position makes for a really good kind of defensive part of a portfolio.
Yeah, and it doesn't help when Ray Dalio says that cash is trash.
Yeah, that was definitely one of the most poorly timed calls.
Well, his hedge fund blew up. So with the risk
Yeah.
parity trade, he got a bailout. Most people aren't aware of that, but he did in late February, early March.
Yeah, I think his long-term research that he's been doing is very useful. He has great charts and they do good research, but he clearly missed it on the short term. I don't know the intricacies of what he was doing and why that didn't work out. I've seen it said that he's not really doing a lot of day-to-day stuff at Bridgewater anymore. So I don't know what the story there was. But yeah, his cash is trash comment was horribly timed, comically badly timed.
Yeah, people needed cash to go buy those quality companies on sale. So cash
Yeah,
is not trash. You've smart investors, all the smart investors I know all have at least a portion of cash in case something like that does happen.
yeah.
So what are the odds in your opinion that holders of physical gold will be looking at a new like windfall profits tax or some other type of tax imposed if gold does go to crazy high levels of $5,000 an ounce or more?
Well, because it's such a small market, it's not really my base case. It's I don't really view policymakers as paying a lot of attention to the gold market. Um, and there are a couple ways to mitigate that. So even if there's not an extra windfall tax, like let's say there's no windfall tax and there's just the current tax rate imposed on it, uh, if gold only goes up by a certain amount to offset currency devaluation, so say it kind of just retains its purchasing power, it doesn't go up in purchasing power, and we just have the dollar weaken and other currencies weaken. If you're then taxed on that gain, then you still lose purchasing power, right? Because if your gold just held its purchasing power, but it went up in nominal terms, and then you pay a tax on that nominal gain, you've lost a small amount of purchasing power. So that's one way that they get it back either way. So in order to make a true gain in gold, it needs to go up in purchasing power enough that even after the normal tax rate that you pay, you're still ahead. So one way to mitigate that is to try to hold some for people that have Roth IRAs or other tax advantaged accounts. If they hold some of their gold investments, either something like the Sprott funds or the gold streamers in that type of account that is, at least in theory, it's tax free, they can reduce that risk by not having all of their gold in, taxable structures.
Yeah, I was going to bring up the royalty and streaming companies. Their business model is really, especially the larger companies that already have diversified cash flow, it's a lot easier for them to adapt than a mining company that might only have one or two producing mines or is building a mine right now. So if a government decides that they're going to put a windfall profits tax on bullion, or a government like South Africa has been talking for almost a decade now about potentially confiscating mines, and to no one's surprise, a lot of mining companies are not investing in South Africa. They're pulling out. So any of these governments, Lynn, that decide that even whispers or rumors of politicians getting elected that they're going to start confiscating mines, these royalty and streaming companies are in the best possible case, the larger ones with cash flow that's diversified, to adapt to that and make investments into other countries that won't do that. So it doesn't mean the shares won't temporarily fall, that would, in my opinion, probably be a buying opportunity for certain companies. But I think they're in the best possible case to adapt to the political winds changing.
I agree, because even if they have bad news, the market tends to overreact in both ways. So when they have good news, the market tends to go up very far. When they have bad news, the market tends to overshoot that to the downside and create a buying opportunity. As long as the company maintains good management and diversification, they can have setbacks here and there, and they can still just kind of shift around as needed. And then even some of the miners, because they've had a period of deleveraging, uh, certain miners still have quite a bit of debt, but many miners have a lot cleaner balance sheets than they had, 5, 10 years ago. So even some of the miners are a little bit more nimble, especially if they have a portfolio of miners that are not too focused in any one jurisdiction, uh, over time.
It's more difficult for an individual mining company. So the mining stock ETFs, there's some good ones, but an individual mining company, if the political winds change and the mining company only owns 1 or 2 mines, and then all of a
Yeah,
sudden something happens, like I wrote an extensive article countering the war on gold video. I spent over 5 hours on it with historical case examples for decades going back. And Ecuador had a really bad tax policy that net effect was almost like confiscating the mines like 5 or 6 years ago, and all the investment dried up. And then they reversed that eventually, and now Ecuador is one of the best places for mining companies of all sizes to invest, or coming up with new discoveries. So things can change fairly quickly. But if the government wants tax revenues, if they want diversified cash flow coming in from mining or other economic activity, because there's a lot of other economic activity that comes in around the mine,
yeah.
then the government should not confiscate the mine, because the historical examples of farmland, oil assets, mines being confiscated, that normally accelerates the collapse of an economy in an emerging market.
Yeah, they look at it as a short-term gain, but then they're faced with the long-term consequences of doing that. So, and I certainly agree that any individual mine is far more exposed to geopolitical risks, and that's why, for people that invest in the miners, it's good to be diversified, or to have not have large positions tied to any one mine.
Yeah, I agree. There's some really good gold stock ETFs, like Frank Holmes is one, Go EU. That's a very solid one.
Yeah, I agree. I like that one.
Yeah, there's Franco Nevada and Sandstorm Gold in there for people who don't want to buy the individual companies, and some other good gold stocks in there too.
Yeah, he focuses on the streamers, and he also focuses on ones that have good per share metrics. So he looks for ones that are creating shareholder value rather than diluting their share base.
Yeah, I think it's a really well designed gold stock ETF compared to like the GDXJ. So the GDXJ is labeled like the junior gold miners ETF, but almost all the gold miners in there are not actually juniors.
Yeah, that's an ETF I avoid. I don't like that one.
Well, I'm not saying it won't go up, because if the gold price goes high enough, these high frequency trading algorithms, these trend traders are going to go in and move up the price. I'm just saying that the underlying stuff in the ETF is flawed though. So
Yep.
even though it might go up, I think there's a lot of problems with the ETF, because people who want exposure to juniors are not actually getting exposure to juniors.
Yeah, I agree.
Lyn, you've been so gracious with your time. I have one more question before I let you go. What industries or sectors do you see as good buys if your global macro thesis plays out the way you think it will?
If we see this kind of longer term debt monetization, heavy like fiscal spending environment, then I think we're more likely to see a little bit of a rotation towards value stocks over growth stocks, and international stocks, at least in certain markets, outperforming US stocks. So every decade, we tend to have these big shifts. So, for example, in the 1980s, Japan was the best performing market. In the 90s, we had the US do very well. In the 2000s, we had emerging markets do very well. In the 2010s, we again had the US do very well. So in the 2020s, with US stock valuations so high, and many other regions with lower stock valuations, and then also even within the US, we had a very big performance gap between uh, the growthier side of the spectrum and the value side of the spectrum. So I think there's a lot of opportunity to find companies that are, in the more value sectors, but you want to find kind of the best ones in there. So the ones with the strongest balance sheets, the ones that actually have good management, that are not like, value traps, that are actually just good, solid companies that happen to have not have been in sectors that really benefit from that disinflationary environment, and to find these companies that are going to do very well in a more reflationary environment. So that's uh, generally value stocks, industrials, some materials, some of the higher quality energy companies, and then some of the international markets, especially when it's part of a diversified portfolio and investors pay attention to debt levels and dollar denominated debt levels.
I think it's a lot harder to find what would have been called conventional value stocks because normally, like, there are the Warren Buffett consumer staple dividend stocks that used to have like low PE ratios that you could get for under 20 times earnings, and they wouldn't leverage up the balance sheet, and they would have some dividend growth. But now with companies that are actually doing well in this environment, like a Costco or a Clorox, those companies are not, their valuations are ridiculous. And some of those companies have a lot of debt on their balance sheet too.
Yeah, I've cited Clorox as an example of a stock that's overvalued. And I've actually done the same with Costco as well in stock waves. We pointed out that many of those companies, certain utilities, certain consumer staples companies, and then things like Costco and some of these other really successful retailers, they've actually gotten very expensive, as you pointed out. And those are not areas that I currently consider value stocks. So the ones that are on the cheaper end of the spectrum are ones that have a little bit more cyclical exposure. But then out of those more cyclical companies, you want to find ones that have low debt levels and that historically do very well coming out of recessions, rather than ones that always find themselves getting diluted and having permanent capital destruction in those more cyclical events. So I like the industrials, especially certain ones, and I like certain international equities, especially on the, again, even in their markets on the more value side of the spectrum. Uh, I have been very cautious about financials, but this past weekend I did become somewhat more bullish on high quality financials as well, because banks currently in the US have 15% cash as total assets, which after all this QE gives them the highest cash levels in modern history. So the only other time they had similar cash levels was 2014 after QE3.
Are you not worried about loan loss reserves though? Because I mean, a lot of people are criticizing some of these banks for not having enough loan loss reserves.
I am worried about specifically ones that have a lot of commercial exposure, commercial loans, commercial real estate. Uh, but I think a lot of the more consumer-focused companies have a better chance of coming out of this with less capital destruction. And so I've been more cautious before, whereas now, as a small piece of a portfolio, I'm more cautiously optimistic at these lower price levels, because even though they have a lot of bad news, the price has, in my opinion, reflected that in a lot of cases.
Well, Lynn, I've kept you for over an hour and we didn't take a break and you just crushed it. Given my listeners a lot of great information. You are truly a wealth of information, an expert in your field. You're really, really good at what you do. I want to thank you again for your time. If my listeners want to follow you on Twitter, take a look at your paid research and newsletter, Seeking Alpha articles, how did they do so?
So I'm at lynalden.com. That's my main website. And then on Twitter, I'm at Lyn Alden Contact.
Excellent. And you have a free trial for Stockwaves, right? If people want to take a look at your research beyond the paywall.
So yeah, on my website, I have a premium service. That one doesn't have a free trial, but it has a refund policy with no questions asked. And then I work with a couple other analysts on Seeking Alpha for Stockwaves, and that one does have a free trial. And that in that service, I combine my fundamental research with some technical analysts. So we have kind of these more decisive entry points and exit points. So we do long, short opportunities in that service.
Okay, cool. So thank you so much for your time. I really appreciate it. Hopefully we can have another chat in the not too distant future.
Yep. Thanks for having me.